We'll get all of the wires plugged in and all the things going that we need to get started here, and see people start to appear here in just a moment. And there we go. All right. So today we've got Ed Patton, and Ed and I are going to be talking about financial fundamentals and um, what you need to know when you own a small business about keeping your eye on the money. Anyway, let's. Instagram's giving me trouble. Gosh darn it. There we go. Who needs Instagram anyway? All right, let's get this show on the road. I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you a small business owner that's thinking about exiting your business now or in the next few years? My team and I are here to help with our unique zero commission program that we've been using since 2016. We can show you what your business is worth, prepare the package you'll need before you meet your first buyer, even run a confidential online advertising program for you just like business brokers do. And we'll coach you through the whole process, or you can hire us to manage it all for you, including coordinating your whole sell-side deal team. Head over to howtosellmyownbusiness.com to learn about how my team and I can help you get ready by watching a series of videos we prepared that explain each step in detail. And if you're ready or just curious to learn more, reach out to us and we'll get you started or schedule a call to answer your questions. I look forward to meeting you and learning more about your business. And just for any business owners out there, the brand new second edition of How to Sell My Own Business is now available over there at howtosellmyownbusiness.com. And you can download a PDF of that for free. If you prefer paperback, you can get it on Amazon. Make sure you find the second edition with the 2025 release date. Today, we've got Ed Patton with us. Ed, how are you today?
I'm good, David. Appreciate you having me on here.
Awesome. And Ed joins us from Texas. And Ed, we're going to be talking about financial fundamentals today, and we're going to be talking about some of the financial blind spots that small business owners can run into. Why don't we start off by giving everyone a little bit of background on yourself, talk a little bit about your history and how you've come to the point in your career that you have, and we'll talk a little bit about who you work with as well.
Sure. Thank you. My background is started off being general accounting stuff. Went to college at the University of Texas, got an accounting degree, went to work for public accounting. I was with back then, it was Pete Mark Mitchell, which has now evolved into KPMG. Then I've also been a controller of a couple of companies and then worked for what would be called today a boutique investment banking firm. We did a lot of work primarily in the state of Texas of helping businesses raise debt money, raise equity money, buy businesses, sell businesses. So that background has been, and I've always worked with small to mid-sized businesses. And today the businesses I work for are anywhere from early stage up to about 100 million in sales. And so, but through that process, through my background, I've been both a generator of financial information for small to mid-sized businesses and a consumer of financial information on the capital transaction side, helping again businesses buy, sell, raise capital. So a common theme that I think a lot of us can relate to is that a lot of these business owners, the business decision makers, the executives had a great ability in their core competencies of the business. But the financial, accounting and financial side of the business was generally not their strong point. And so there's a hole there. I think there's a hole a lot of us have seen where, again, they're strong on operations. That includes sales, customers, competitors, personnel, all that. But they're not strong in accounting and finance, and that's something that, as we all know, is important.
Well, you just said accounting and finance, and for people that don't know, can you define the difference between accounting and finance?
Sure. Accounting is recording the transactions, and then finance is really understanding those transactions, understanding the business, and then putting it to use for either knowledge the uh, of the decision makers, or for knowledge of third party capital, debt money, equity money, or selling a business. And I cannot underscore enough the need for quality accounting. And there's something I have that I call the 10-hour rule, and that is, for every hour you screw up accounting, it takes 10 hours to fix it. And I tell businesses that when you get into that situation, and generally the first reaction is no, that can't be correct. Then after you go through the process of fixing that, they'll come back later and say, I'm not sure 10 hours is enough. So it's yeah, do it right. Do it right the first time.
I often say that accountants are historians. They record
Yes.
what happened, and that finance people are planners. They're trying to look
Yeah.
forward to figure out what you want to do. And the reason why people are not as familiar with finance, the finance profession or disciplines, etc., is because there's no H&R Block of finance. The average person on the street knows about accountants and may run into one for their own personal tax return, and certainly within any business they run into some kind of accounting function. But a truly professional finance function is usually only going to exist within a company of a certain size. And so, for most small businesses that haven't grown to be big enough yet to have that full time or even a fractional finance person, that finance role sits on the lap of the owner typically, because they're making decisions like, do I invest in that new machine? Do I go and get that loan, etc.? And these would all be what we would categorize in that sort of CFO functionality, right?
That is correct. And there, you're. I mean, I hadn't thought about it, but there's not an H&R Block for finance, and that's a good point. Uh, Accounting is a pretty uh, finite or definite activity. In finance, you kind of alluded to it, is different things. Can I buy this piece of equipment? Do I want to sell the business, or whatever the financial issue is? And so it takes different it goes different directions at different times in the corporate life of the business. And so there's really not one straight on function like there is for accounting.
Yeah, yeah. Well, let's talk about financial fundamentals for non-financial owners. Could you tell us, what you think are some of the biggest misconceptions small business owners have about, let's call, financial health?
Sure. Well, the biggest one is they think that the P&L is the financial business, that is the entire picture, and
Yeah.
it's not the entire picture. And there's a lot of reasons for that, but kind of going to the prior point is, there's not a sort of a definitive, this is finance type deal. And really, that's what I've done with the five elements of financial fundamentals. And I'm not. I want to come back and make sure I answer your question. But uh, what the financial fundamentals, they're all always important, but they're not all always critical. And so, but again, over the life of a business, this one may be critical today, the other one may be critical tomorrow, something may have been critical in the past, or maybe none of them are critical right now. But but the thing is, you don't know when that critical situation is gonna happen. And so you just need keep your eye on the ball on those all the time, know what their trends are, and know what's driving them.
You said a lot of business owners are focused on the P&L or income
Yeah.
statement. And then earlier in our conversation, you talked about how business owners are typically, within their zone of genius, which often is operational,
Sure.
marketing, execution, et cetera. And I think it makes sense to me that the income statement basically is like, how much did you sell? What did it cost you to deliver those goods? What were your expenses at the office, et cetera? The income statement or P&L really describes that operational activity,
Yes.
And so it would seem kind of natural that this is where people would gravitate towards because it's reflecting the things that they have their hands on all the time. Maybe a bit more so than the stuff that's over on the balance sheet.
No, no, that is right. And there's three, as we all know, there's three basic financial statements. There's a balance sheet, an income statement, and a cash flow statement. So along those lines, I've written a blog on this, but it's a, a subjective grading system on my part on those three basic financial statements, with the grading system being a red light, yellow light, green light. And so the of those three basic financial statements, most business owners that you're talking about understand well the P&L, and it's extremely important. I mean, it is the operations, it is the business, but also the P&L is logical and intuitive. So it's really kind of easy. You start with sales, and then cost of sales and expenses, and you have net income. So that all makes sense, and it's important. But then you go to the balance sheet and to the cash flow statement. I give the balance sheet a yellow light because it's it's logical, but it's not intuitive. And the
Mhm.
reason is it's logical, but it's not intuitive because there's good things and there's bad things on it. You know, there's the assets, cash, then there's liabilities and there's equity. So they're all there for a good reason, and they're all actually laid out in a elegant way, but they're not intuitive, and so the business owner doesn't understand them. Then the cash flow statement I give a red light to because it's neither intuitive or logical. It's yeah, that's a whole nother discussion for another day. But in the operations segment of the cash flow statement, there's working capital components. There's things that really are not
It's more
operations.
like a math puzzle, isn't it?
Yeah, and
It's like
a
it's
puzzle's
like
good.
a
Yeah, but
it's like a formula that my teenagers would bring home from math class.
it's yeah, no, that's a good way. It's all there, but it's not in the right places. But you can take it and go, oh, wait a minute, I'll take this number from over here and that number from over there, and I'll put it over there, and it can start to make sense. But to the business owner that's trying to run his business, it doesn't make any sense. And by the way, the P&L I give a green light to because it's logical and intuitive. I'm not sure I said that, but anyway, so one other thought on the balance sheet and the cash flow statement. I believe business owners stop asking their advisors what they mean because they know they're important, and they've asked them what it means. And, 15 to 30 minutes after they've asked the question, their eyes are rolling over in the back of their head, and they forgot what the question was because the answer is so laborious and so confusing. It just doesn't work very well.
So you and I have both met many business owners probably who, as you pointed out, they're having trouble with the balance sheet and the cash flow statement, but they know they need to know where they stand. And so do you think this is why so many business owners just fixate on bank balance? Because they figure if they can have that under control, then they don't really need to understand what's
Yeah.
going on the balance sheet and the cash flow statement?
No, I think that's right. They understand it. I mean, they can relate to it, and but there's so much more going on. As somebody once described me, a good salesman is somebody that can't see all the activity under the surface of the water. They just see the smooth water on top, but there's fish and sharks and all crabs and all kinds of things underneath the surface of the water. And so they can see the cash and they understand it, but there's just so many other things that are going on, and it's never presented to them in a way that's intuitive to them, and it's clear and concise. So you know they know they ought to know it, but why waste my time asking the question because I never get an answer I understand anyway. So, and that's why, and we've all seen this before. Too many business owners get to a situation where their liquidity is in bad shape, and it doesn't happen overnight. It's been coming for a while, but they never saw the trends, they never saw the drivers. So, you know, yeah, David, I'm sure you have. We've all had those phone calls. I need some money? Can you help me raise some money? I've got to make payroll next Tuesday. Well, by that time it's usually too late.
Yeah. Yeah. It's because the first question that any kind of lender or investor is going to want to know is how did you end up in this situation? How did you not see this coming? Because if you really are in control of this business and managing what's going on, then you should have had earlier warning signs, right?
Correct. That's right. So they're just kind of stuck then at that point.
Now, you were a guest speaker in the Business Buyer Advantage Group coaching program. We went kind of deeply into the five different financial fundamentals that you talk about quite often, but I want to target one of those, which is the target liquidity measure. Is that what you call it? To have the term right?
Yes, yeah. Is it financial
Okay.
health or liquidity? Is that same
So,
interchangeable?
so can you tell us how that number that you've come up with as part of your system, how it differs from what you would find in the traditional financial statements, and what does the number try to show the business owner?
Sure. Let me go through the calculation of liquidity, my
Okay.
calculation, and then the target number after that. And so the trenders have two proprietary reports. One is the cash flow statement for reasons I've talked about, but and then the other,
Trenders are your clients
the
who,
trenders are that's my,
yeah.
I've trademarked the word trender, so TRENDER. But anyway, um, and so uh, so liquidity is the other proprietary report. Generally, liquidity is when it's conveyed or discussed to businesses. It's in a ratio. Current ratio, quick ratio. Whatever it is. And when you're talking to a business owner, and if you say to them, David, you've got a liquidity problem because your current ratio is 0.95 to 1 and your industry should be 1.35 to 1, he's not going to have clues to what that means. And so the liquidity calculation that the trenders use is a dollar amount, and it's cash on hand, which we talked about. If you have a line of credit, it's availability on the line of credit because that amount is accessible, very easily. Um, and then it subtracts past due payables because you can always build up cash by not paying your payables on time. And then any large upcoming payments, which are usually income tax or property taxes. And so you sum all those up across the table. There's a chart, there's a calculation I go through, and then that gives you a dollar amount. And then the target is it's one month average 1 month's cost to run the business. And actually, David, I don't know why that's a good target, other than experience has shown that it's a good target. That
Well,
and let me so what it's also, to me, it's really not so much that you use the trender target, but you have a target. It's
yeah.
people, yeah, you know, three payrolls or whatever. I've seen different ones that are out there, but at least have a target so you have something to be shooting for, and then test that to see if it's effective and it works.
So this is why I wanted to have you on the show.
Okay,
Like this thing specifically because you're talking about available credit. Well, available credit doesn't show up anywhere on any of the financial statements.
correct.
You're talking about past due payables, making a distinction between past due and current. Well, on our balance sheet, we see our payables, but it makes no distinction between past due and current, right? You also mention upcoming payments, which again don't appear on any of the income financial statements anywhere. Like I guess you'd have a long-term debt maybe, but what you're looking at is what payments are going to be due here imminently, and as well as things like tax payments, which typically don't appear anywhere on our financial statements until we've made the filing and made those journal entries into the accounting software, right? And so I thought it was interesting because when you first described this to me, I thought to myself, "Oh my goodness, I've seen every business owner lean back in their chair and look at the ceiling and do this calculation that you just described in their head, where they're thinking about, I have this money, this much I'm
Yeah,
going to collect in the following week. I got to pay these bills. I know my taxes are doing." Like it's exactly what you're describing, and what you're doing is you formalize it into a system so that people get this report card with this number, and they'll know if they're doing well or not mathematically just by looking at that. Like it's almost like a score in a game.
right. No, that's right. And it's what I tell people is I want to come back to that point, but you need to have business and economic reality. You don't need accounting theory or finance theory. You need reality. So that's what the whole purpose of this is. And yes, you're right. The owners kind of go through this in their mind, but uh, what the trenders do. I don't mean to keep putting an advertisement on there, but I will. But is they formalize it and they show thank you, and they show trends and drivers, and so very easily You can see, are you going in the right direction or not the right direction? Very easy to drill down and see, is that from operations or, something CapEx or debt service or
Mhm.
whatever. And so very easy, again, it takes 2 seconds then to see that what that number is, and then you can drill down easily and see what the drivers are. And you mentioned income tax. There's just one situation where a client who paid or had his taxes once a year as a sub S, some kind of pass through. And I remember he had a $400,000 tax payment. He said, "Oh my gosh, we're in trouble." I said, "No, don't worry about it. It's all baked in. Your liquidity's in good shape." Because, but I just wrote a check for 400,000, and he's, even though we had these reports every month, he didn't pay attention to it till he signed a check for 400,000. But so I said, "Don't worry about it. It's
That would
all
be
baked in."
alarming to a lot of people. That would
Yes.
be alarming to a lot of people. Yeah.
Well, and part of this was developed just through experience, and that is, if you don't have this, and one case comes to mind, the owner comes back from a meeting with their tax guy, goes, "Yeah, I got to write this huge check, and I don't have the money, and so, or where am I going to get the money?" And so, that's all this is evolves over time, and you're going, you realize you really ought to have your arms around that all the time. Uh, so you're not on April 14th scrambling to try to get the money.
We're kind of stepping into the next sort of section I wanted
Okay.
to get into, which is, when the owner of the business is trying to also be the CFO, what are the most common blind spots? And I think things like tax bills that have not been recorded yet, or aren't on paper anywhere yet, are a big one. What are some of the other things that you commonly see?
It's really, David, it's really almost anything that's not on the P&L. And so, I've seen where CapEx, they didn't realize CapEx was being made. Debt service, they look at the P&L, logic, understandably, they look at it each month, and they can see what sales are and earnings are. But that's kind of the extent of it. And so they don't know what they don't know, and so that's where those, you talk about blind spots. That's where those spots come in. So I think that the answer to your question is, it's really the biggest problem is just uh, things that happen in businesses that are not on the P&L. I mean, there's working capital components whipsaws your cash, and so uh, again, it's you need to have access to all that, uh, what's going on all the time.
Okay. What do you think people commonly overlook when they're making decisions about borrowing or investing or growth?
Well, that's good. What I do, let me answer it this way, and I'm not sure this is going to answer it, so come back at me if it doesn't. But I look at that liquidity side of it. So if they're making plans for the future, let's say they're going to build a building or buy a piece of equipment or buy a business, so you go through and you put projections together, and you see where your liquidity is. And so if after this activity is anticipated, or even just day to day life, and you're undercapitalized, you're illiquid, that money has to come from somewhere. And so generally, if you've already got a line of credit, it's not coming from there. It has to either come from debt or equity. And there's really not a right answer. I think I'm meandering away from your question, but it was just, uh, in different owners have different priorities. Some are against dilution, so they don't want to sell any equity, and others are against debt. And so, again, if you come back to, you have to have this much liquidity, now where are you going to get it? And but also the reciprocal of that is true too, where you go through the process. I remember a company was going to build another building, and they had the borrowing capacity and the liquidity that it wasn't going to be a problem. And so, my point to them was, you have the financial wherewithal or capability of financing this business, so don't worry about that. Now start thinking strategically. Do you really want to build this building? And so, yeah, then the other's true too, and that is, it may be a good idea, but how are you going to finance it? And so then, yeah, the point is to tee up the issues And then through these discussions, the right answer comes out. But if you hadn't teed up the issues, you're never going to get to the right answer.
Yeah. With respect to something like building a building, I find sometimes business owners will bring what I call their homeowner mentality into their business.
Mm-hmm.
And they'll say, geez, I'm paying a lot of money to the landlord, and maybe if we owned a building, it would be better for us financially. We wouldn't be paying that money out anymore. And then you get into a conversation of, well, what are your growth plans? And do you intend to serve different markets? And do you intend to do this or do you intend
Mm-hmm.
to do
Mm-hmm.
that? But would building this building or being in this particular locale then hem you in from other future opportunities coming down the road? And I always like to draw or point out the example of Walmart, because Walmart very rarely owns its own retail stores. They do own a lot of their distribution centers, but those are key strategic assets. Whereas the retail stores, they understand that if they put a down payment on a building and then get that very low growth in the value of the property, it doesn't make as much sense for
Mm-hmm.
their capital as simply leasing and investing their own money in inventory, which turns over very quickly and generates a lot of uh, gross profit. But on top of that, they think long term, and they know that if they lease a building for 10, 15, or 20 years, at the end of that span of time, very probably the retail patterns may have changed. New highways, new exit ramps,
Mm-hmm.
new neighborhoods, new developments, and that may not be the right place to be anymore. And I find that a lot of small business owners just aren't even thinking about those times of time frames or scales or opportunities down the road.
Yeah, no, that Walmart example is really a good example, and and small businesses have a finite access to capital, and so do you really want to tie that access to capital up in real estate? And and again, David, it depends on what your plans are.
Mhm.
I'm in San Antonio, Texas, but Texas, most of my lifetime, the real estate market has been a good market. I mean, there's been ups and downs, but so a lot of the mentality here is if if you own the real estate, you're going to 20 years later, it's going to be worth more. And so, but again, that's not Walmart either. They're they've got a factory, they'll stay there, but generally the companies that have owned the real estate have made money, on the real estate. But I've always heard that AT&T always never liked to own real estate. That's not where they want to tap their capital. So again, it just kind of comes back to uh, what do you want to do? If my business is going to be a $10 million sales business in this location, for the next 20 years, maybe it makes sense to own the real estate. But no.
Yeah, if your location is part of the strategic element that makes the
Yeah.
business operate, then yeah, it's a different decision, right? Um, so this is great. What can a business owner do to build financial literacy without becoming an accountant? What do you think are some of the things that someone could do?
I think they ought to demand from their advisors, just give me financial fundamentals. I mean, it's going to sound like an advertising again, but again, this part of the reason I developed this is because of I would get asked that question. And you're right. I don't want to be an accountant. Just putting myself in the shoes of the owners or a finance guy. But what do I need to know? And early on, my answer was I don't know. And so to me, after using it and seeing it being effective, they just ought to demand. I want to know what my financial fundamentals are in a clear and concise manner, something I can understand.
And do you think that
Other than
these
that, I don't know. I don't know how to answer that question. Other than
do
that,
you think some of these things could end up being different by industry?
no, I don't. No, I don't think so. I've worked with companies that are uh, helping a friend sell a retail business here locally. It was doing 300,000 in sales, and at the same time, I was working with another company that ended up selling was doing 100 million in sales. But fundamentals are fundamentals. And I think it's industry agnostic. Other than owning a bank. I mean, a bank has different criteria, and an exploration and production oil and gas company because their assets are not necessarily on the balance sheet. they're in the ground, that you can't see that's coming out in a future date. So, other than those two, distribution, manufacturing, uh, agriculture, real estate, I've never really done just because real estate is a simple uh, financial model. It's not a simple industry. It has a lot of risk to it, but it's all pretty straightforward. You own an asset and has tenants, and they pay rent, and you pay the expenses. Anyway, so no, it's generally speaking, it's very industry agnostic because fundamentals are fundamentals, and economic and business reality is reality, and so I think it's pretty much effective across the board.
We've got people who have popped in from all over. We got Kevin here, who's in Central Florida, who says good afternoon. And if you're watching live and want to ask Ed a question, please go ahead and pop it into the notes. Um, are there certain financial dashboards that you think people should implement? And is that why people sign up with you to become trenders, because they're looking for that kind of easy to understand financial dashboard?
Well, what I tell people is the trenders of financial fundamentals are not in lieu of effective reports or dashboards. They're
Okay.
in addition, or KPIs. They're in addition to, and so it's really, first of all, it's the big picture. Then get into your dashboards and your KPIs, but see the financial big picture, and that's going to help you put in perspective other financial and operational information. So. Yeah, I think, I think, David, there's a lot out there. There's a lot of dashboards and a lot of KPIs out there, and I think whatever you and your advisors, I would bounce it off of people that you trust to say, here's what I'm looking at. Is it what I should be looking at, and get advice there. But I don't know. I can't think of any one that I've seen that's been more effective than us. And a lot of them, they're really flexible, so they can provide information on dashboards or KPIs on a whole different slew of different activities.
Yeah. And KPIs, for those who don't know, it
Yeah,
means key performance indicator. And examples of that might be like in the airline industry, they track revenue passenger miles, for example. In the freight railroad industry, they've got, I don't know, tonnage per mile of track that they have. Like different industries will have different
sure,
things. I know in the hotel business, they'll have like the last 7 days average revenue per room. And so just quick
sure,
numbers that let management know, are we doing well, are we doing not, like do we need to maybe stop and look at it for a problem or look for a promotion or something of that
sure,
nature.
sure.
And what you have to do in your business, you have to figure out is, what are the key things I
Yeah,
want to measure in the business that are going to lead to success. So it sales is one that people often think about, but the reality is that maybe if you have some kind of sales group within your company, and you can't really incentivize sales, but you can certainly measure the number of outbound calls made, for example. And so you know that if you make more outbound calls, you're going to get more conversations, you're going to make more sales, et cetera. So you actually watch the outbound calls to see how, if that's going up or down. So this is what we mean by KPIs. Um,
and and
borrowing
and,
compa-
and, and,
Go
and
ahead.
David, I
So
just say, if those KPIs are doing well or trending well, or the opposite is true too. Generally, your financial fundamentals will start trending well too. But again, at least on the P&L. But then if you're putting a lot of money in capex or debt service, it may be a different issue. But anyway, yeah, I agree with what you're saying.
yeah, I want to talk more about borrowing capacity,
Okay.
because, as I mentioned earlier, it's something that doesn't appear on the balance sheet. What extra room do you have on your credit facilities that you might have access to? So, can you give us an idea about how borrowing capacity is part of the strategic toolkit? Like, most people just think of it as a fallback if there's an emergency. If something goes wrong, I've got access to this money. But I think there could be some more strategic ways to use that, aren't there?
Yeah. What again? What I do is I like to just show it's a generic calculation of what your borrowing capacity is. It's trailing 12 months EBITDA less estimated taxes, and I can't remember what else is it. And then you put in, you know, I could get loans at at 8% at 7 years. So you put all that into the system, and it spits out, and then a coverage ratio too. So from that, it spits out this cash flow supports 5 million in term debt. I'm just making up a number, but you've already got 3 million in term debt. So then you can borrow an additional 2 million. Again, that's graphed out so you can see what direction you're headed. And so even if you are not going to be borrowing money or anytime soon, it's still a good data point to see if if your fundamentals are going in the right direction or not the right direction. And so I don't know that did that answer your question? I'm not sure.
Well, I guess what you're talking about is a little bit more theoretical. You're talking about what this business should be able to support as far as debt. I
Correct.
guess what I was alluding to would be like unused credit facility. Like, and do you see the difference between those two?
Oh, you mean like on a line of credit?
Yeah, like if someone has a line of credit of $500,000, but they've only used 50 grand, I mean, that extra 450. Do you look at that in your
Oh,
calculus as
absolutely.
in a certain different way from borrowing capacity?
That's one of the few components of the liquidity. So it's cash on hand plus
Right.
availability on the line of credit. And so, so yes, it's extremely important. It's really it's part of it's a big part of your liquidity. And
But is there a strategic way we can use that? So I'll give you an idea. For example, if you were planning to, I don't know, buy a piece of machinery and you were shopping around for debt for that new machinery, could you use your unused credit room as a negotiating tool? Because in what I've always been told is the best time to look for credit is when you don't need it.
sure, sure.
Right.
Yeah, very much so. So just say, $500,000 piece of equipment or something. So if you have room in again, come back and look at the liquidity. So if you've got $1 million in liquidity or room left in your line of credit, and you're going to buy a piece of equipment for 500,000, well, your availability has gone down by that 500,000. But if your liquidity is still okay, you're okay. Uh, then also, how much term debt does your cash flow support too? So you can look at it. So you could borrow money that way maybe, and then not tap into the liquidity side. So when you're talking about strategically, what I found is to go through these 5 elements, and we look at it and say, okay, here's what you want to do. What impact does that have on the 5 elements? And so
Mm.
so that's it's to me it's not in a vacuum of just the line of credit, but it's in the holistic approach to the business. So
And just can we go through that again? The five
sure,
elements that,
yeah,
yeah.
okay. It's cash flow, operating earnings, liquidity, shareholder value, and borrowing capacity or term debt supported by cash flow. So and what I found is if you have your arms around those 5 items and you know their trends and their current situation, their trends, their drivers, you can recognize, and this is a number I pulled out of the air, but 95% of financial situations that are going to arise. And so then now, again, what goes from being important, all those 5 are important, but what is now critical? And if you're going to buy a piece of equipment, that now becomes critical because it's not theoretical anymore. It's now something you want to do. And and I've had one situation recently where this kind of go off to an aside. The shareholder values in there, like the borrowing capacity, it's a generic sort of theoretical calculation.
So
But
it's not just the equity section of the balance sheet.
no, 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 no. It's again, it's a calculation. It's trailing 12 months EBITDA. By the way, the trenders are all built from existing balance sheets and income statements. Plus, if you have a line of credit, a borrowing base report, how much can you borrow on your
Mm.
line of credit? So it's all stuff you have, and all this financial fundamentals and everything is locked up in those reports, but they're never presented to somebody that makes sense. And so, but going back to this example, this person had a business, it was doing well, and then he had a series of, I don't know, 5 or 6 months where things were really doing well, And so, again, even though the equity is or the value is there all the time, said, look, let's let me have this conversation with you. I just noticed you have a this thing has a lot of value to it, and more so than in the past. And he was never the same again. He realized that, oh my gosh, there's some real cards on the table here, or some real money on the table. And so he hired an investment banker, went through the process, and sold his business. And uh, so the point is, you just need to have again, the value side is another good data point, or it's one of the fundamentals. Is it going in the right direction or not going in the right direction? And it's just good knowledge to have. And if it can be presented intuitively, clearly, and concisely, uh, then it's good. And what I tell people, I've got the 10-second rule, and that is, after people have seen this for a while, they can really get their arms around the full financial picture in 10 seconds each month. And so, that has value.
Is there anything else that we haven't talked about today that you think we should bring up in this conversation?
No, I was going to. I put a sales pitch on. There's a report card
Sure.
that comes out, and that is those five elements have a red light, yellow light, green light scorecard, so that of those five elements: cash flow, operating earnings, liquidity, value, and borrow capacity. So each month you can see, and there's a 3 month deal in there. You can see, hey, this month did you have a red light, yellow light, green light, and that's and also it's interesting, David. I've just thought about this, or hadn't mentioned this, but the cash flow and the P&L drive the capital side. The capital side being liquidity, uh, uh, value, and borrowing capacity. And so the cash flow and the operating earnings, those zigzag a whole lot, but really the capital side is a sort of a bigger ship that turns more slowly. And so those things drive the capital side, but generally 1 month is not going to kill your liquidity, or kill your value, or something like that. So yeah.
Yeah, you mentioned earlier when we were talking about the liquidity number that you had learned over the course of time, what a certain target might look
Right.
like. So, how long have you been using these fundamentals and the trender reports with your clients?
Well, it's all evolved. But probably 15 years, and so I'll start off doing part-time controller work, part-time CFO work, and so again now it's really focused on financial fundamentals, because it's important, and it's not readily available.
Okay. And you mentioned earlier who you're working with, but who is the ideal client? Who would you like to be working with if someone out there needs some help?
Generally speaking, it's a company that's, say, on smaller range, 2.5 to 5 million in sales, up to 30 to 50 million in sales, and they can be early stage, but they have to be well capitalized and really have plans for future growth, and they need this information. A lifestyle business that's really small doesn't need this, and so, but once you get up to that 2.5 to 5 million dollar size, the first thing that happens is you lose track of your cash. You don't. You used to be, when you're smaller, you could pretty much look at your P&L and relate that to cash. They all kind of fit together. But once you get bigger, the, the cash gets whipsawed by non P&L items, working capital components, capex, debt service, whatever they are. So then there's just a disconnect to where it's that age old question of, gosh, my profits are up, but my cash is down. So that's, if you're looking at cash flow correctly, that answer ought to fall out in about 2 seconds.
This has been awesome, Ed. Thanks for coming in to see us today.
Sure.
Where can people find you if they'd like to have a conversation with you?
I've got a website, which is Patton Trender, no S's, so it's PATTONTRENDER.com, and there's a contact place in there, which is info@Patton Trender. Or my phone number is 210-822-9977.
That's awesome.
All
We'll
right.
put your website address and your LinkedIn profile
Good.
link down in the notes below here as soon as we wrap up. And uh, Trance and Soccer say thanks, David and Ed. And I would say thank you for joining us live there today. And thanks, Ed, for coming in. And I'm going to wrap this up. And I want to thank you so much for stopping by today.
Great. Thanks, David. Thanks for having me.
So, how can you learn more about buying, selling, financing, and managing small and medium-sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.